Today's webinar is focused on the One Big Beautiful Bill Act and what it means for you and your business. Please take a moment to review the disclaimer on the screen. By attending this webinar, you acknowledge and agree to these terms. I'd like to introduce our moderator, Brendan Walsh. Brendan is the CSH tax leader and a shareholder who specializes in tax consulting for businesses and their owners. His work focuses on strategic tax planning to minimize tax exposure, specializing in fixed asset strategies, depreciation, cost segregation, and tangible property regulations in the construction and real estate industries. Brendan has worked with companies ranging from startups to billion-dollar publicly traded entities. I'll pass it off to Brendan to introduce our presenters and kick off the first poll question.
Great. Thanks, Allie. Good afternoon, everyone. It's a pleasure to get to talk to everyone today about the new tax law. We have a lot to cover, certainly, so going to quickly introduce our presenters and do a quick poll question initially, and then we will dive right into the content. We have a lot to cover here in 90 minutes. So our first presenter is Zach Gubser. Zach is a tax shareholder who works on tax compliance, planning, transactions, and controversy projects for clients ranging from individuals to pass-throughs, as well as large multinational corporations. Zach has a wide array of industry knowledge and a great deal of experience working with manufacturers and service companies. Zach focuses on strategic planning opportunities and minimizing tax exposure for his clients. Our next presenter is Brittany Lawrence. Brittany is a tax shareholder who focuses on business tax planning and compliance. In addition to multi-state experience, Brittany's industry focuses include real estate and manufacturing. She helps clients fulfill compliance requirements of the various taxing authorities while minimizing tax implications and providing valuable tax planning strategies, including multi-tiered partnerships and Section 1031 like-kind exchanges. Brittany works frequently with the IRS and the state of Ohio, resolving conflicts and assisting clients with audits. And our third presenter is Mark Gaudette. Mark is a tax shareholder who serves as an advisor to corporate executives, high net worth families, and closely held businesses and their owners. He assists clients with their income, estate, and gift taxation planning, as well as compliance matters. Mark is a senior member of both the firm's personal wealth planning and executive assignment groups, which specialize in asset planning strategies. So before I kick it over to Zach, we do have our first polling question here. Overall, what sort of an impact do you think OBBBA will have on your business? Positive, negative, it won't affect us, or not sure? So if we can go ahead and take a few seconds there to answer that question. For those of you that may miss a polling question, it should be posted in the poll tab that you should see on your Teams bar. So you can access that even after we may close out the poll. So yeah, you can see about 44% so far are saying positive, 44% unsure. We have a handful saying negative and a small handful saying it won't affect us. So interesting there. You know, if you read, if you've read some articles, I'm sure many of you have, about the impact of this bill or the lack thereof, it's interesting because a lot of speculation is that the real impact would have been if the bill had not been passed, and the TCJA provisions of 2017 that were set to expire at the end of 2025 would have had much more of an impact than maybe this bill itself does. Now, we're going to go through certainly certain industries and situations where there will be an impact and want to talk through that. But yeah, certainly some thought out there that the bigger impact would have been if the bill had not passed. So, okay. With that being said, we will go ahead and move to the next slide, and I will turn it over to Zach Gubser. Zach.
Thanks, Brendan. I think it's helpful to start with a brief discussion about the process, the timeline, and how we got to where we are today. If you think back to 2017 and the passage of the Tax Cuts and Jobs Act, it's, we all lovingly call it the TCJA. We went through a similar budget reconciliation process to what we saw in 2025. So there's similar one-party control, and the reconciliation process allows that controlling party to pass legislation with a simple majority. So importantly, that can avoid the potential filibuster in the Senate. But one key rule with the reconciliation process is that the legislation must be budget neutral, meaning it cannot be projected to increase the deficit over the budget scoring period, which is typically 10 years. So it's that budget neutrality requirement that led Congress to phase out some of those TCJA benefits and fully eliminate them at some point. So if you're wondering why the bonus depreciation rates have been phasing down, why the limitation on the business interest expense deduction had become more severe, it's because of that budget neutrality rule. And as Brendan just mentioned, at the end of 2025, we were headed for a tax cliff. The qualified small business deduction, the 20% deduction on pass-through income, was set to expire. The lifetime gift and estate exclusion was set to fall back to pre-TCJA levels, among other changes. So it was critically important to a lot of taxpayers that Congress got something in place by the end of the year just to prevent us from going over that tax cliff. The Senate was initially pushing for separate reconciliation bills. They wanted to handle border security and defense at the outset and then kick tax legislation to the end of the year. Ultimately, the president and the House won out. They combined everything into one big, beautiful bill, as they call it. So on this slide here, you're going to see some of the key dates. Ultimately, the most important date for the legislative process was July 4th. That's when the legislation was signed into law. You'll also notice, I mean, there's a bunch of dates in between, but we have the inauguration day there. This becomes an important date. There are certain provisions in this legislation, certain benefits that if you placed an asset in service after January 19th, so if you placed it in service on inauguration day or later, you'll qualify for some benefits. But when you see January 19th littered throughout this legislation, that's what it's tied to. And then one last point on the slide, the dates before July 4th aren't critically important, but I think it's important to note the speed at which this legislation was passed. I think it's obvious certain provisions were likely drafted before the process started, but all the negotiations and the trade-offs that happened very quickly after the process started. So there are definitely components of this bill that lack clarity, and those last minute changes as things were getting incorporated, they couldn't cover everything. So we do, without a doubt, know that we are going to see additional guidance, and we do need additional guidance. And there are certain places in this bill where Congress has given the IRS explicit regulatory authority to clarify some of these provisions or to explain how they'll be implemented. So we know additional guidance. It's going to be coming throughout the webinar. There's going to be places where we will explain where we lack some clarity and where we expect that guidance. So
Zach,
with that,
Zach, yeah, just real quick. I think it's interesting when you look at this slide and we think about prior legislation that had been enacted, TCJA, really a lot of provisions in TCJA were subject to sunset. They were all subject to sunset at the end of 2025. One of the key words that we've heard a lot in this legislative piece is the word permanency. And so a lot of these provisions, they're touting that they are permanent in nature. And I think it's important that we focus in on that word a little bit and what that means. So, Zach, if you want to color that a little bit, I think it would be helpful.
yeah, when they say permanent, it means it's not going to sunset or it's not scheduled to expire. So absent legislative changes or Congress come in and revoking these cuts or something along those lines, permanency just means it's in the law and it will be in the law until Congress acts, if they ever do act in the future. Go ahead.
Yeah, so I think it's the first time since about 2001 that I can recall a lot of those provisions were really hard sunset provisions that got extended or modified. And this one, they're really touting the word permanent. But again, that's just a buzzword, and we know as the makeup of Washington changes through the years, that some of these provisions are going to be revisited. So the other thing that Zach mentioned when we looked at this slide is the importance of the inauguration date. And unlike past bills, there's a lot of different enactment or effective dates of some of these provisions. Some will go retroactive to January 1 of 2025. Some will have a key date that focuses in on an effective date of the inauguration day. Some will phase in 2026, 2027. So as we go through the presentation, we'll try to hit the effective dates, and then we'll probably color those more in future conversations.
Yep, thanks, Mark. And then I think one final point to add is these changes were done through the reconciliation process, and I think in the future could be undone through the reconciliation process. So don't necessarily need the filibuster-proof majority if either Republicans have full control or Democrats have full control. So permanency with these budget-related provisions is even a little bit potentially less permanent than other legislation. So with that, I'm going to kick it over to Brittany Lawrence. She's going to get us started with some of the provisions most impactful to the businesses.
Yeah, thanks, Zach. So what I heard you say is permanent doesn't necessarily mean permanent in the way we all think of the word. So now that Zach has taken us through the legislative update and kind of, how we got to where we are today under the new act, like you said, I'm going to cover a few key changes with respect to business entities. So first up here, qualified business income, QBI deduction, or 199A. Again, this was a TCJA created provision under 199A back in 2017 for pass-through entity owners, S Corps, LLCs, partnerships. And this deduction really was designed to show rate parity between C corporations and pass-through entities. Ultimately with a goal of leveling the playing field from a rate perspective. And as we mentioned before, this deduction had been slated to expire after the end of this year, after the end of 2025. And under the new law, this deduction is now quote unquote permanent at 20% with no change to the rate. Some of you who have been watching this throughout the summer and spring, you may recall that under the House version of the bill, they wanted to increase this deduction to 23%, but ultimately it ended up keeping at 20%. A couple changes under the new law also expands the deduction limit phase-in ranges, and that's going to apply to specified service, trades, or businesses. The expansion will also affect the phase-in ranges for W-2 limitations as well as asset basis limitations. So again, this is a taxpayer-friendly change. It's going to give a greater benefit to those pass-through owners, especially those that may have been limited before under those lower phase-in ranges. And one thing it does add that is new, it's a new minimum QBI deduction of $400 for taxpayers with at least $1,000 of QBI income related to active businesses. So essentially, all in all, the continuation of that 20% deduction basically means that top marginal rate for QBI income is going to stay at 29.6. And how do I get to 29.6? It's 37%, which is the top marginal rate, times 80% to take into account that 20% deduction. So again, if left to expire, this would have been a significant jump back up to 37%. And I know many business owners were watching this very closely, and this is definitely good news.
Yeah, Brittany, and I think there was no change in the definitions of an SSTB and a qualified business. So it's really just kind of the extension of the provision with some modifications made to the phase outs.
Yep, that's correct. Yeah. Okay, so on the next couple slides, we're going to be focusing on capital asset planning, and that's really a tried and true tax planning strategy that many companies have used to accelerate tax deductions. And first up here, bonus depreciation. That's been around for as long as I can remember, varying percentages through the years. And this new law makes a permanent change back to 100% bonus depreciation. for assets that are acquired and placed in service after January 19th, 2025. So that's that magic date that Zach talked about. Comes up a couple of times in this new law that we're going to talk about. So essentially meaning if an asset was acquired, placed in service on inauguration day or after, then 100% bonus is going to apply. And you may recall that under the prior law, we were dealing with 40% bonus depreciation for 2025, and that was phasing down by 20% each year. So it is a significant change, pro-taxpayer change. All of the same rules apply in terms of what property is eligible for bonus depreciation, meaning that it must be personal property, less than 20-year life, and it can be new or used. And also bonus can be used if your business is in an overall loss situation. So again, very taxpayer friendly. We've been dealing with that phase down of the bonus depreciation since 2023. I know many tax professionals and many of my clients had been anxiously waiting this change back to 100% for some time now. And this permanency of the change really should allow for more long-range planning, asset planning, because it's going to give more rate certainty. And again, bonus is a great way to accelerate that tax depreciation when a company is investing in CapEx, and also use that deduction to decrease tax exposure and ultimately increase cash flow. And then just a quick side note about the increase of the percentage in bonus, that is significantly going to increase the benefit of a cost seg study for real estate. So if you're in that space and you've acquired or rehabbed a building or are planning to in 2025, you'll definitely want to consider a cost seg study. Okay, on this next slide, qualified production property, QPP, is a new provision under the bill, and it introduces a 100% deduction for qualified production property. And that's going to include 39-year property. So basically, this is a new section within the bonus depreciation section of the code. And so what is QPP? It's going to apply to non-residential real property used either in manufacturing, agriculture, or chemical production. So we're going to need some definitions. We're going to need some clarification on a couple areas of this. But a couple key dates to keep in mind here. Construction must begin after January 19th, 2025. So that magic date pops up again. Must be placed in service after July 4th, 2025, which is the date of enactment, you might recall from that chart that Zach went over, and placed in service before 2031. So a couple of important details to be aware of. It must be used by the taxpayer as an integral part of a qualified production activity. So things like offices, spaces related to sales functions, administrative functions, anything that's not directly related to production is not going to be eligible. So there's going to need to be a carve out for those spaces that are not related to production. Must be placed in service within the United States. The original use must begin with the taxpayer. And this is going to be an area that we're going to need some clarification on, because I know it's very common for real estate to be owned within a separate LLC entity, not connected with the operating company for liability reasons. So they're going to need to clarify, what does the taxpayer mean? Does it have to be within the same entity, or does a related real estate company qualify? And one last rule here, it is subject to recapture if during the 10-year time period after you place it in service, if the building ceases to be used in a qualified production activity, you're going to have to recapture that benefit. So again, another pro-taxpayer change, pro-United States manufacturing, but again, several details to be clarified either by technical correction or IRS guidance. And it was really going to create a lot of incentives, I think, for taxpayers to expand or develop new manufacturing properties in the United States. Because if you think about it, that's a significant impact when you compare the 100% bonus depreciation versus what would be under a 39-year straight line, which was applied to the building piece before QPP comes into play. So significant change under this provision. And then on the next slide, section 179, again, another strategy to consider when you want to pull tax deductions into 25 by accelerating tax depreciation. And the new law makes a couple of changes to the thresholds, increases that limit to 2.5 million for 25. And that had been slated to be just 1.25 million for 25. So a doubling of the amount that's allowable under 179. Also increases the threshold, the phase out threshold to 4 million. So if you acquire more than 4 million of qualifying property in 25, your allowable 179 deduction will begin to phase out. And those thresholds will be adjusted annually for inflation. And just a couple of reminders, Section 179 is a little bit different in bonus in that it allows you to fully write off the cost of qualifying purchases like equipment, machinery, but the taxpayer must have taxable income. So in other words, Section 179 cannot take your business into a loss. And another thing to keep in mind, typically if you have trust owners within the S Corp, you're going to have some limitations on the amount you can take under 179. So, and then on the next slide, business interest expense limitation under 163J. So you may recall this was one of the revenue raisers under the TCJA back in 2017. Definitely not taxpayer friendly when it was first introduced, and it creates a potential limit on the amount of business interest expense that can be deducted. So what we were dealing with prior to OBBB was a 30% limitation, which was based on EBIT, which is earnings before interest and taxes. And that this new law essentially reverts back to EBITDA by increasing that cap by excluding depreciation, amortization, and depletion. So ultimately, again, this was another pro-taxpayer change to existing law. Especially for businesses that have significant depreciation, amortization, and have some debt, and maybe they were dealing with the limits of the ability to write off that interest expense. I think this change could also potentially result in free up of prior interest expense that was held up under EBIT and could be freed up in that carryover calculation. So again, something to keep in mind moving forward. There were also a few other changes made under 163J, clarifications to the treatment of interest capitalization, a few expansions of the definition of what's in adjusted taxable income, as well as a couple other details related to controlled foreign corporations. So if you're in that space, you'll definitely want to reach out to your tax advisor to discuss those specifics. So with that, I think I'll turn it over to Zach for R&E.
Thanks, Brittany. I'm going to start with a discussion of Section 174 Cap A. So that's the new section addressing domestic research and development expenses or research and experimentation expenses. As you see on the slide, starting in 2022, taxpayers were required to capitalize and amortize research and experimental expenses incurred during the year. So for domestic R&D, it was capitalized, amortized over 5 years. Foreign R&D or R&E was capitalized, amortized over 15 years. Foreign R&D is still required to be capitalized and amortized over 15 years. That didn't change. But with this legislation, Congress did reinstate the ability for taxpayers to deduct the domestic R&D expenses in the year incurred, rather than forcing the capitalization and amortization of those expenses. This is a welcome change for a lot of taxpayers. If you think back to late 2022 and 2023, I know some people on this call will remember, we were very, very hopeful that Congress was going to repeal the requirement to capitalize R&D. I think most people in the industry expected that it was going to be repealed. Never got that repeal. We extended a lot of tax returns that year, hoping we were going to get some type of tax relief that never came. Congress ultimately didn't act. So we still, we suffered the ramifications of those R&D expense add backs until now. Taxpayers with significant R&D were, heavily impacted by this add back. So going forward, taxpayers are going to have the ability to deduct domestic R&D, but then what happens about the amounts that were capitalized in earlier years? This is an area we're going to need some regulatory clarity for sure. Small businesses, which are businesses looking at their 2025 gross receipts, if they are less than $31 million for 2025, they'll qualify as a small business. They have the opportunity to amend prior year returns and deduct the R&D expenses in those years that they were incurred and capitalized, rather than deducting them in subsequent years. So based on the text of the legislation, it appears that each of the years impacted, so 2022, 23, and 24, all of those years would need to be amended, not just one of the years. And then again, if you read the text of the legislation, it looks like the mechanism for claiming the deduction in 2024 is an amended return. Even though some 2024 returns are currently on extension, have not been filed yet, under the legislation, it looks like the mechanism is you're going to have to file it. You're going to have to determine what your 2025 gross receipts are, and then you're going to have to go back and amend 2024. So that's what it looks like right now, but I'm sure we will get some additional guidance. But then alternatively, the alternative to electing to amend the returns, if you're a small business, or for the taxpayers who do not qualify as a small business, they have the option to fully deduct the capitalized unamortized R&D in 2025, or they can split it over 2025 and 2026. Now, technically, it's the first tax year that begins after December 31st, 2024, but for the sake of simplicity, we're just going to say 2025 and 2026. But again, whatever option the taxpayer chooses here, IRS has been given explicit instruction to issue regulatory clarity. So we know that there's going to be guidance forthcoming, and we know we'll have a little bit more information on the mechanism for deducting these expenses. It seems like a lot of taxpayers probably are going to be in a position to deduct in 2025 or 2025 and 2026. I think there'll be fairly limited circumstances where amending the prior year returns makes sense. Certainly those circumstances will exist, and I think we'll just have to look on a taxpayer by taxpayer basis, evaluate what are all of the options and which one is best for that specific taxpayer. There's a lot of factors that are going to come into play with those determinations. Potentially there's AMT for passive owners, all kinds of other things. And then you ultimately have to make sure that you're looking at that taxpayer, the ultimate taxpayer's ability to actually deduct business losses. So if we're going to generate a bunch of deductions in 2025 or 2025 and 26, or carry them back, we ultimately want to make sure that if we're generating losses, that we can utilize those losses. So on the next slide, we talk about excess business loss limitations. And some of you who operate sole proprietorships or own pass-through entities, you may already be aware of this limitation. It's a limit on the ability to use business losses to offset other sources of income. So, wage income or any other sources of income you have. For a long time, we've had limitations on the ability of non-corporate taxpayers to take losses. I mean, there's passive activity loss limitations, basis limitations, but this was a new layer of loss limitations that came about with TCJA. The COVID legislation that we saw back in 2020 and 2021 actually suspended this provision for a while. Then the Inflation Reduction Act came in and extended it, and then now the OBBBA has made it permanent. For 2025, this limit is $626,000 for joint filers, $313,000 for single filers. So what does that mean? If I'm a joint filer, my partnership passes out $1 million of losses in 2025, I will only be able to deduct 626,000 of those losses. The remaining 374,000 then carries forward as an NOL. Now, when we saw early drafts of this bill, when they were moving through the House and moving through the Senate, they were going to treat the excess business loss carry forward as business loss in the next tax year and in subsequent tax years. So what that was going to mean was, if you had $100 million loss, you're going to be limited to $626,000 every year going forward. Ultimately, the legislation that they passed is going to treat the carry forwards as an NOL, and that's the way it was under existing law. So, you're limited to 626,000 in the tax year those losses are incurred, but then carrying it forward, you're not subject to that same limitation again. And the carry forward is treated as an NOL. You still do have the limit where you can only offset 80% of taxable income in a given year. So there is some planning that needs to be done here as we're generating deductions, but again, we'll take a look at that with all our taxpayers. And I think there was a question on R&D.
There was, Zach. Yeah. So, if we can we flip back a slide, Ethan? Thank you. So this has to do with the second bullet point. It says, can they elect to do, they can elect to deduct in 2025 or split between 2025 and 26. Can they follow the original amortization schedule and still expense all of 2025?
I think they can. I think that's another point we'll need some clarity on, but I do think the 2025 and 2026 deduction, I think that's an option. Now, somebody can correct me if I'm wrong, but I think they could continue with the amortization schedule. And I do think they also have the option, if they wanted to elect to capitalize these expenses, they could continue doing that. But I think, yeah, so going forward, I think this is an option to take that deduction in 2025 and 2026.
Yeah, I would agree with that, Zach. I mean, to your point, it's not crystal clear, the answer to that question, but it would make sense that they'd be able to continue that amortization from prior year R&E expenses.
All right, so moving along to section 1202. This is the last one I'm going to talk about in detail, but yeah, we could do an hour and a half on section 1202 by itself. I'm not going to subject you to that right now. We're just going to highlight some of the changes that we see in the bill. When I say section 1202, many of you may have heard of the qualified small business stock gain exclusion. So, you sell qualified small business stock, you can exclude some of the gain. High level, certain C corporations that qualify under the code, when the taxpayer sells that stock, they can exclude the gain on the sale of that stock from their income. Now, in recent years, taxpayers have been able to exclude 100% of the gain on the sale of certain stock they held for 5 years. Again, there are certain other requirements, qualifications, but that's high level. After 5 years, you can exclude 100% of the gain. There's a balance sheet test that you need to look at to determine if the C corporation is a qualified small business. And the maximum gain that could be excluded was either $10 million or 10 times your basis. So, a bunch of requirements there. Under existing law, it was 100% after 5 years. Under the new legislation, the change that they put in, after 3 years, so if you have a 3-year hold period, you're eligible to exclude 50% of the gain, assuming you meet the other requirements. After 4 years, you're eligible to exclude 75%. And then after 5 years, you're then eligible to exclude 100%. So still get the benefit of the 100% exclusion after 5 years, but they're bringing in a little bit of relief for people who don't meet that 5-year hold period. And then additionally, the balance sheet test that you were doing for for the small business determination was based on $50 million under existing law. That's going to jump up to 75 million, sorry, to determine if you're a small business. So it gives you a little bit more breathing room if you're going to do some type of conversion or try and get into a corporate entity that qualifies for 1202. Then lastly, maximum gain under existing law was either $10 million or 10 times your adjusted basis. That's been bumped up to $15 million or 10 times your adjusted basis. And then as noted there on the slide, this applies to stock that was issued after July 4th, 2025, so the enactment date of the legislation. Again, the details of 1202, that is a webinar in and to itself. We're just highlighting some of the changes there. A lot of planning can be done and is done to make sure we have some Section 1202 qualifications in certain circumstances. But here we're just going to highlight the benefits or highlight the changes. Moving on to the next, some other changes. We're not going to talk about these in detail unless we have a little bit of time at the end. But we do have experts at the firm here that can handle these, that if you do have questions, please reach out. We'll get you in touch with the right person. But there were some extensions and changes to the Qualified Opportunity Zone program and the New Markets Tax Credits program. There were some international provisions that changed with this law. And then a lot of press was dedicated to the green energy changes, the tax credits that were repealed or eliminated or sunset, just various changes. So again, we have experts here that can talk you through those. We're not going to talk about them unless we have some time here at the end. But yeah, with that, I'm going to kick it over to Brendan for the next polling question.
Thank you, Zach. All right, poll question number 2. Do you think OBBBA impacts businesses or individuals more? Give you a few seconds to respond to that poll. And for timing purposes, we are going to go ahead and move on to the next slide. But as I mentioned in the beginning, you can still answer that poll using the poll tab within Teams. So it does not go away for you. And with that, I will kick it over to Mark to talk about some of the individual tax provisions. Mark.
Yeah, perfect. Thank you. I'm interested in the poll results as they continue to scroll in. I see this, and right now it looks like there's a combination of business overweighting a little bit between both. But when I think about the majority of the clients that we serve at Clark Schaefer, we serve a lot of phenomenal businesses, but the majority of those businesses end up the taxes paid down by the individual level. So I think there's a lot of nice provisions that are impacting the operating entity itself, but a lot of the impact will come down to the ultimate taxpayer, which oftentimes is an individual. So I was just curious in those results. And so we're going to go through a series of the individual provisions and talk about what changed or what did not change. And I'm going to make a parallel on most of these between the current law under TCJA and then what we have with the One Big Beautiful Bill Act. So under the new act, we have really the extension of the favorable tax rates that were pushed forward to us in 2017, where we have a top marginal rate of 37%. As we've talked before, the top marginal rate was subject to sunset back to pre-TCJA levels, which would have been a 39.6 top marginal rate. A couple of other things that happened, there were no changes in the brackets. We still have a 7-bracket system in the individual income tax arena, going from a 0 tax rate to 37%. And we still maintain a 4-bracket system in the estate and trust arena on the income side, where we have a top marginal rate on the estate and trust income side at 37%. Recall that we get to the top rate in trust taxation of 37% at a very, very low threshold in the neighborhood of about $15,000. So lower brackets in the trust system, or less brackets in the trust system, compressed brackets. The next topic is the personal exemption and the senior deduction. Under TCJA, we had the deduction for personal exemption was temporarily repealed. This was made permanent with the One Big Beautiful Bill Act. So when we talked about permanency, we're talking about the fact that there's no sunset on the repeal of the personal exemption, meaning it's not scheduled to come back into play at any point in time. That exemption was eliminated back in 2017, and I would argue was replaced most likely with the increased standard deduction that individuals had. A new provision was added with the new act for tax years 25, 26, 27, and 28. And this deduction is a $6,000 deduction for each qualified individual that's obtained the age of 65 or older before the close of a taxable year. This deduction is subject to a phase out starting with modified adjusted gross income over $150,000 for married filing joint taxpayers. This provision is kind of the workaround when under the President Trump's campaign, there was a promise to eliminate, there was a goal to eliminate tax on Social Security benefits. This is kind of the disguised no tax on Social Security benefits, but it's limited to a small population. It's limited to a 4-year window here. And again, it's subject to a phase out provision. When we talk about phase outs, as we start to look at the individual provisions, there's two key targets that we look at. Oftentimes we'll talk about adjusted gross income, and then we'll talk about modified adjusted gross income. And modified adjusted gross income is used generally when we're looking at some limits related to maybe child tax credit, education credits, the premium tax credits, the ability to make deductible IRA contributions, the net investment income tax. So they talk about modified adjusted gross income. And for each level that we're looking at, or each criteria, when we're looking at the definition of modified adjusted gross income, it changes a little bit of what's included. But oftentimes we'll have the foreign earned income exclusion is added back to your adjusted gross income. That's predominant in most of the definitions of modified adjusted gross income. It could be the add back of tax exempt interest. It could be the add back of the non-taxable portion of Social Security benefits. But again, it looks at what criteria we're looking at and how they define modified adjusted gross income for that calculation. But for the new senior tax benefit deduction of the $6,000, this is the disguised no tax on Social Security. Standard deduction, as I mentioned earlier, there was an increase in the standard deduction as part of the TCJA. It basically doubled the standard deduction to a very high amount. And as we've seen through practice, a lot of taxpayers starting in 2018 through recently filed 2024 returns, there's a lot of individual taxpayers that have been defaulting to the standard deduction now, as opposed to taking itemized deductions. And that's a result of a couple of factors. One is the SALT cap that we'll talk about that was introduced in 2017. It will also be some of the limitations that's on mortgage interest. And then obviously the disallowance of the majority of the 2% miscellaneous itemized deductions that we had prior to 2017. But with the big beautiful bill, what was we've made permanent the higher level of standard deduction. This takes effect in 2025, and on this slide we show you what those levels are, what the standard deduction will be for this tax year. So for 2025, a married filing joint taxpayer, this standard deduction will be $31,500. This bill has a couple of interesting provisions as we look at ways in which, when Zach was talking about the scoring that takes place to try to get a neutral level of tax bill. So obviously there's some revenue raisers that are out there. one item that was put into place here was the repeal of the P's limitation back prior to enactment of TCJA. So the P's limitation was an item in the tax calculation that would disallow a portion of an individual's itemized deductions. It would scrape a portion of their itemized deductions if they were over an income threshold. So the favorable part of the big beautiful bill is that it has repealed the P's limitation. So that P's limitation is not coming back into effect. But the workaround is they added a new cap on itemized deductions, starting with taxpayers that are in the top marginal bracket. So that's individuals that are paying the 37% tax bracket. And there's a calculation that's done, and it's reduced by 2/37 of the lesser of either the amount of itemized deductions or the amount by which the taxable income exceeds the dollar amount at which the 37% bracket begins. So when I boil this down to one comment would be for individual taxpayers that are in the 37% tax bracket, the benefit on their itemized deductions is they'll receive 35 cents on the dollar. So in essence, it's capping the benefit of your itemized deductions at a 35% rate as opposed to the top marginal rate of 37%. That's the way I would interpret this provision. And so this will take effect for those taxpayers that are in the 37% bracket, and they'll pay a little bit more tax as a result of that. This provision takes effect for tax years beginning in 2026. So it will not impact your 2025 return, but it will have an impact on returns for tax year 2026. The next item is the cap on individual state and local income tax. So when we talk about the SALT cap, we're talking about personal state and local income taxes, property taxes, tangible property taxes, real property taxes. This cap was enacted back with TCJA, probably one of the most unfavorable provisions that was in the tax bill as it related to individuals back in 2017. This was a highly debated item and has been debated since the enactment back in 2017. And there's been a lot of states and a lot of folks trying to push for a higher deduction limit. So, but what's ended up is they have increased the SALT cap to $40,000 for tax years beginning here in 2025. However, there is a limit on the income level. And so the sweet spot for the increased SALT deduction of up to $40,000 for your state and local income taxes, your real and personal property taxes, is $40,000 starting in 2025. But the sweet spot is if your adjusted gross income is in excess of $600,000, you'll fall back to the $10,000 cap. So for those that are under $500,000 on a married filing joint return, you should be able to benefit from the total SALT cap of 40 grand if you incur those expenses. For those in the $500,000 to $600,000 range, you'll have a phase out of that cap from 40,000, but to no lower than 10,000. So for the high income taxpayers, those that are in the 37% bracket, this provision is the way it was with the enactment of TCJA back in 2017. You'll still be limited to a $10,000 deduction. One of the topics that was discussed and was debated quite heavily between the House and the Senate bills was for those that have operating entities and the pass-through entity tax that was enacted as a workaround for the business income provision for the business income and state taxes paid on that business income, and the workaround that was allowed for the pass-through entity tax. There was a lot of discussion on whether that was going to stay part of the law. So the favorable news is for those that have operating companies and you've been using the powerful tool of the pass-through entity tax, that provision is still in play. And so we're looking at the state and local income taxes and real and personal property taxes that fall on your individual tax return. And we still have significant planning tools that can be used to help reduce the impact of the SALT cap for operating entities.
Yeah, just to add a little more color on that, in response to this SALT cap, most states throughout the country that have an income tax implemented legislation allowing you to deduct the taxes on the pass-through entity's tax return. So deduct the taxes from income. You're not going to have to then separately deduct those taxes on your Schedule A subject to this cap. So it was a SALT cap workaround. A lot of people know it as the PTET legislation states were implementing, but those are still very viable strategies and very valuable strategies. We've done a lot of planning over the past few years. We'll continue to do that planning. Still remains something that I think a lot of business owners can benefit from.
Yeah, Zach, I think when this provision first came out and everyone kind of saw the headlines of increased cap to $40,000, I had a lot of clients reaching out and saying, does that sort of eliminate the need for the PTET workaround? And I think the answer is no. In many cases, PTET is still very viable because of that phase out that Mark talked about. If you're in excess of 600,000, you're still only going to get 10 on your Schedule A on your individual return. So for many clients, that PTET is still a very valuable tax planning strategy.
Yeah, it was really interesting watching these bills work their way through in a very quick period of time, and the angst that some of us had for the business owners out there, and with the potential elimination of the PTET, it was pretty stressful to figure out how this was going to play out and be favorable to business owners, which I think is one of Trump's goals, is to make sure that doing business in the United States is the place that it should be done, and that we should be incentivized to do business here. There was a part of TCJA, if you recall, back in 2017, is that there was a cap that was put on qualified residence interest, and this is for the purchase or improvement of your primary or secondary home. Prior to TCJA back in 2017, one could borrow up to $1 million of indebtedness if secured by their primary or secondary residence, and that interest would be deductible as an itemized deduction. With TCJA, the cap was reduced to $750,000, and that was effective for any indebtedness incurred from December 15th, 2017 forward. There was a grandfather provision that allowed those that had existing mortgages in place to continue to deduct with the higher cap of $1 million of an indebtedness. This provision that was part of OBBA makes it permanent, that we're now at the $750,000 limitation, but we still do have the favorable grandfathering provision for those that had debt incurred prior to December 15th of 2017. If you are looking to refinance and you have mature debt out there, just make sure that you talk with your tax provider to make sure that we can continue to have the favorable rate or the favorable deduction and take this expanded cap if possible. The other provision that was introduced back with TCJA was the elimination of using the deductibility of home equity indebtedness. And so that was if we use the equity in our home to buy other assets or make improvements to our property. That exclusion is no longer that interest is no longer deductible, and under the big beautiful bill, it was made permanent in this act. So not a lot of significant changes, just capping it at 750,000 of indebtedness, and making sure that if you go through a refinance situation, that you talk with your provider to make sure that that you don't lose the ability to take maybe a higher level of a deduction. The other thing is, when we're looking at home mortgage interest, this is for the purchase or improvement of your primary or secondary residence, and the residence has to be collateral on the loan. And so there's oftentimes people will do some type of financing prior to get into locking into permanent financing. And again, if they do securities-backed lending or other things through their financial advisors, make sure you're having a conversation with your tax advisor and understand those provisions and whether or not when you go into permanent financing secured by the residents, whether or not that interest will be deductible or not. Those rules are a little tight, and you want to make sure that your provider understands the full fact pattern and provides you the proper guidance. There were a couple of changes that are being made to charitable deductions, and these are going to be provisions that take effect on January 1st of 2026, so they will not impact the filing of the 2025 tax return. One of the provisions is that there's a limit on the deduction for charitable contributions. And so they're putting a floor on the amount of charitable contributions that are non-deductible, and it's 0.5% of your adjusted gross income. So the way to think about that is starting in 2026, if you qualify to itemized deductions and you make charitable contributions, 0.5% of your adjusted gross income, that calculation will result in a portion of your charitable deduction or your charitable contributions being non-deductible. To put a little number behind it, if you had $1 million adjusted gross income, 0.5% would be $5,000 of charitable contribution. So if you made a $25,000 charitable contribution to the Greater Cincinnati Foundation, and we were subject to this limitation, your AGI was $1 million, only 20,000 of that would be deductible because you'd have to cross the 0.5% AGI limitation. So this is going to have a little bit more impact on charitable giving as we start in 2026. Oftentimes, the clients that I deal with, they're making charitable gifts for the benefit of the organization, and the tax benefit is an added incentive, but not the main driver. But there is going to be a little bit of reduction in the deductibility of charitable contributions starting in 2026. The other thing that we saw is that they're bringing back what I would consider above the line. So when we talk about the line in the tax situation, we're talking about adjusted gross income. You can recall for a few years back in 2020 and 21, I think we had a $300 or $600 above the line charitable deduction for those that made charitable contributions. These have to be cash contributions to a qualified 501c3. If you weren't itemizing, you could take a limited deduction above the line. They've increased that, and they've implemented it to a $2,000 deduction above the line starting in 2026 for those making cash contributions to a qualified 501c3 and do not itemize on their individual tax return. This next slide is going to talk about scholarship granting organizations, and this is a new provision that's been added as a part of the One Big Beautiful Bill. This provision starts in tax years after December 31st of 2026. So this is a couple of years out. But the reason that I want to cover this provision is because we've seen a lot of states implement a tax credit, not a tax deduction, but a tax credit for contributions to scholarship granting organizations, or SGOs as we refer to them. So when we have a tax credit, that's a dollar for dollar reduction in our tax liability, as opposed to a tax deduction, which is a benefit but is limited to the marginal rate in which we are paying our tax. So starting in 2027, there is now going to be a federal tax credit up to $1,700 for contributions made to scholarship granting organizations. There are Ohio benefits, there are Kentucky benefits for making SGO contributions, and generally where you'll see this is in a context of private schools, K through 12 private schools, some of the parochial schools that are out there. And so this is the ability to make a contribution to that school to provide scholarships for underprivileged individuals. The benefit is it's tax neutral for taxpayers because the organization is getting they're getting the charitable contribution. You're getting a tax credit up to the amount that you donate and limited to certain limitations. So on the federal side, it'll be 17,000. In the state of Ohio, we have a similar provision for SGOs, which is $750 per individual. For a married couple, it's $1,500. And so these provisions have been out there on the state side for a couple of years. Now we're going to see a federal provision. The downside to this is if you're taking advantage of a state credit and we receive a credit for on our state taxes, we cannot double dip and also get a federal credit. So there'll have to be a balancing act when we start to get into 2027 on whether or not we're going to take the deduction or we're going to take the benefit of the credit on the federal or the state side. But I would strongly encourage for those that support these types of organization. It's a neutral sum game for the taxpayer. The charity wins. We're neutral from a tax standpoint because the dollar that we give to the organization, we're able to offset dollar for dollar on our income taxes. So we put out a couple thought pieces a couple of years ago on SGOs. I authored a piece. And so these are going to get a little bit more traction, but the federal provision comes into play starting in tax year 2027. If you have not taken advantage of the SGO on your state income taxes and there's the schools that you would like to support, make sure that you reach out to your tax provider. These contributions need to be made in the tax year. So it's a provision that we have to make the contribution in the current tax year. And if you don't make it by December 31st of the given year, you will not qualify for the credit for that tax year. This slide is going to cover a couple of miscellaneous itemized deductions. I think when I started this presentation, I talked about TCJA and the limitation of the 2% miscellaneous itemized deductions. These were permanently repealed with the One Big Beautiful Bill. And so when we look at these, because we often get questions, are my investment expenses deductible? So those would be your investment management fees that you pay to your financial advisors. Are my tax preparation fees deductible for the preparation of my individual tax return? What happened to my unreimbursed employee business expenses? And then certain legal fees. So these will continue to be non-deductible. We've been under this regime since 2018, so we're kind of used to this, but these were made permanent. So these will not be brought back into law unless there are legislative changes in the future. One of the provisions that was enacted with the Big Beautiful Bill was a limitation on the amount of gambling losses that an individual can take. So I'm going to talk about a recreational gambler, not an individual that's engaged in gambling as a professional activity. But under the current law, you're able to offset your gambling losses to the extent of gambling winnings, no more. So we can't take our losses in excess and receive a tax benefit for that, but we're allowed to offset our gambling winnings by the actual gambling losses that we incur. The gambling winnings are reported above the line in the calculation of adjusted gross income. So it's included in our income calculation. If you were to itemize your deductions and you took advantage of the itemized deduction as opposed to standard deduction, and you had gambling losses are reported as a miscellaneous itemized deduction, not subject to a 2% AGI threshold, but subject to the extent that you have gambling winnings. One of the changes that occurred in 2026, so it's effective for tax years beginning in 2026, is that they are going to continue to limit gambling losses to the extent of gambling winnings, but they're only going to allow you to take 90% of your gambling losses in a given year and not be able to offset 100% of your gambling winnings, but offset 90%. So a little bit of a tax pickup here. So this is one of the little revenue raisers that are out there. I believe Zach, you might have a comment on this because I think this is an area that we're already seeing a lot of traction on in commentary.
Yeah, there's a lot of chatter coming out of Washington on this provision specifically.
Probably coming out of Nevada, but that's okay.
That's exactly it. They got their no tax on tips, but a lot of them didn't realize that this was in the legislation when they voted to pass it. So um, there's a lot of senators out there, some representatives that are already saying that they want to fix this, and by fix it, mean go back to the 100% of losses still allowable rather than 90%. So um, yeah, I think whether that happens in separate legislation, whether we get additional reconciliation bills later in the year, we can talk about that a little bit later. But this is one provision that it's getting a lot of press in the past few weeks.
Thank you. I think when Trump was on the campaign trail, one of the provisions that he talked about was the ability to deduct interest on auto loans. So there is a provision that was enacted to allow the deduction for interest paid on auto loans. There are a lot of guardrails on this provision. It's only available for tax years 2025 through 2028, so a 4-year run here. The amount of interest that's deductible is limited to $10,000. The type of vehicle is also limited, but probably the main criteria is it's got to be a new purchase, a new vehicle. So it's got to be original use with the owner. And it also has to have the final assembly must occur in the United States. So a lot of provisions that are going to take effect here, and whether or not you're able to take advantage of this deduction is going to be a fact-based situation. And then to further limit it, it is also subject to a very significant phase out for modified adjusted gross income over 200,000. So one of the issues that we have with this big, beautiful bill is that we have big, beautiful phase outs at a lot of different levels. And so when I think about the impact on individual taxpayers, when I think about the individuals that are already paying at the top tax rate of 37%, a lot of these phase outs, they're going to work their way all the way through, and they're going to be subject to the limitation on their charitable contributions starting in 2026. There's going to be a limitation on the tax benefit of their itemized deductions being capped at 35 cents on the dollar, as opposed to 37%. The ones that are in the brackets that are in the 35% bracket and lower, there are provisions that may or may not apply. That could be the SALT cap, that could be other provisions. So now is the time to be talking with your tax advisors. They start to digest these provisions in your personal situation and think about the application it may have. Again, provisions, some will be effective in 25, some will be effective in 26, and then this would allow for some planning opportunities on maybe some things that we haven't done in the past. And for those that are not in the top bracket, and we might be able to capture that very nice increase in the SALT cap from 10,000 to 40,000. There's planning around that we might want to think about, and maybe have a strategy that's effective for 1 year, but not the next, and figure out how we want to go about that. So I think it is the time to plan, and just working with your advisor to make sure they understand your specific situation and they can walk you through the thresholds and phase outs when all of this occurs. The alternative minimum tax was enacted way back in the day, back in 1986. So it's been around for a long period of time. We were pretty blessed with legislation that was passed with TCJA that increased the exemption with the alternative minimum tax calculation, and it increased the exemption to $1 million. The positive of the big beautiful bill is it extends the higher exemption and the phase outs, but it's making some modifications to the phase outs, which unfortunately is going to drag potentially more people into the alternative minimum tax because they're going to be phasing out their exemption at a little bit quicker rate. And so on this slide, I show an example that The phase out is going to reset back to 2018 levels, which makes it $1 million exemption. Without that reset, the exemption for 2025 is $1,252,700. The alternative minimum tax, again, has been around for many, many years. A lot of taxpayers have not been subject to the alternative minimum tax because of this increased exemption. It is a parallel tax system. It is a parallel calculation that tax professionals run for their clients. Oftentimes, many clients are unaware that this calculation is occurring because unless you're impacted by the alternative minimum tax, you wouldn't know much about it. So historically, we had a lot of clients that would have been subject to alternative minimum tax with the lower exemption when they had favorable tax rates on their qualified dividends, on their capital gains down at a lower rate. The alternative minimum tax system is a flat rate of 26% for the first 175,000 of income. There's an exemption phase out where we can go up to the top rate of 37%, and then it falls down into a top cap of 28% once you're all the way through the exemption. So very complex calculation that is done. The whole point of this slide is I think we're going to start to see more clients slide back into alternative minimum tax starting in 2026. So this is one of the hidden revenue raisers that we need to pay attention to. Your tax providers, your tax professionals should be running calculations. They should be running multiple year calculations so we can see the impact of what 2025 and 2026 look like based on the facts that you provide, and see if we can make some planning determinations between the given years. The next two slides are two provisions that President Trump campaigned on: the promise of no tax on tips and no tax on overtime. So these were enacted temporary deductions for tax years 2025 through 2028. So they do apply for the current tax year. The deduction is limited at $25,000 per taxpayer. These two provisions have a lot of guardrails on them also. So these are fact specific. We need to make sure that the facts line up. And so in general, they would be customary tips and received by wage earners that work in professions that are generally getting tips. The IRS has promised that they will release a list by mid-October of what those professions are that are customary to get tips and what that would look like. This will be a reporting that requires the tips be reported on a W-2 or a 1099. The deduction will be an above-the-line deduction, which means that we don't have to itemize in which to receive this benefit. For the no tax on tips, if you are a married taxpayer, you must file a joint return. And although there will be no federal tax on the tips, if you qualify, limited to $25,000 per taxpayer, subject to phase outs based on modified adjusted gross income over $300,000 for a married filing joint taxpayer. Payroll taxes will still apply. That means that Social Security and Medicare taxes will still apply. State and local income taxes will still apply to those tips that are exempt from federal income tax. The next slide is another campaign promise on the no tax on overtime. Again, very similar to no tax on tips. This has a 4-year run, 2025 through 2028. This deduction is also limited to $25,000 for joint filers, subject to a similar modified adjusted gross income phase out of $300,000. Again, not required to overtime, and payroll taxes will still apply to the no tax on overtime. There's going to be a lot more guidance provided on these two provisions, really to fine tune who it applies to. But in a general context, if you're paying overtime at time and a half, tax will apply to the standard overtime rate. It's the additional bump on the overtime is what they're looking to exclude from tax. So if you're in an industry that pays time and a half for overtime, those employees might receive a benefit on a portion of the overtime pay, but not 100% of the overtime pay. So a lot of nuances to these provisions. If you're a business owner or a recipient of these types of benefits, it's something you want to make sure that you understand the law before you make any changes to your estimated tax payments or your withholding. Similar to the no tax on tips, payroll taxes will still apply. So that's the FICA and Medicare piece, the Social Security Medicare piece, and state and local income taxes will also apply to this provision. Couple slides on a little provisions. 529 plans were introduced a long time ago. There were a couple of significant modifications that were made to 529 plans that I think you should be aware of. There is an increase in the amount of 529 plan distributions that can be used for K through 12 expenses. So tuition for private schools for K through 12. That legislation was enacted a few years ago where they opened up the gate where you could use your 529 plan to start to cover K through 12 tuition, and that was capped at $10,000. It's scheduled to go to $20,000 starting in 2026, so effective for distributions in tax years after December 31, 2025. They also expanded the list of eligible education expenses that qualify. And so you might have additional expenses above tuition if we are going to take distributions from a 529 plan to get to the $20,000 per beneficiary. But it can include such items as books and materials, advanced placement fees, standardized test fees, tutoring fees. So they've expanded the list of eligible expenses that would qualify for some of these provisions. Another provision that was added is that the big beautiful bill allows for 529 plan distributions to cover qualified post-secondary credentialing expenses. So this allows for some trade operations and other things. So really, they're looking at opening up the 529 plans to cover more than just your traditional college or $10,000 for tuition to private schools for K through 12. So nice benefit here that there's been a lot of money put into 529 plans. And recall that 529 plans grow tax deferred if the distributions are used to cover qualified education expenses, which has been expanded here. Those distributions are income tax free. So they grow tax deferred. Qualified expenses are distributions are tax free. If you take a distribution and it's not for a qualified education expense, it's subject to income tax and it's subject to a 10% penalty. Similar to the way Zach and Brittany put together their presentation, there's a couple of other provisions that are out there. There's the extension of the child tax credit. It's going to be up to $2,200, subject to phase out. There was an increase to the adoption credit, and then there was a permanency made to the personal casualty losses. And the thing I think about with personal casualty losses is pretty much in today's world, it has to be related to a federally declared disaster area. They also allowed provisions where governors can now make those provisions for their specific states. They may not have been covered by a federal declaration, but a governor has the ability to also make that provision that allows for disaster relief loss on these casualties in limited circumstances. That's a summary of the individual income tax provisions. I've got one slide on the estate and gift exemption, and I think the greatest thing that happened is that we've made the exemption permanent at $15 million per individual starting after December 31st of 2025. So for your current planning, the estate and gift exemption is at $13,990,000, and it goes up to $15 million starting on January 1 of 2026. So we've got some level of permanency. This was one of the items with TCGA that was subject to sunset. We were going to go back down to $5 million index for inflation. So we're pretty well set here with the $15 million exemption. And as was enacted many, many years ago, this has been codified that we don't have a clawback provision. So if at some point in the future they reduce the exemption below $15 million, we don't have to worry about the giving and gifts that we've made with the higher exemption amount. a very short slide on Trump tax accounts. I'm not quite sure what president named these accounts, but obviously with the current president, he introduced this provision. This was on the campaign trail. It's a new tax deferred investment account for children that can receive up to $5,000 per year up until they reach the age of 18. So it can be funded up until the age of 17. There's no distributions allowed prior to the age of 18. Half of the account can be liquidated for qualified expenses up to the age of 25. The entire account must be liquidated by the age of 30. These funds must be invested in mutual funds or exchange traded funds that track a qualified index. And the earnings are going to be taxed at long-term capital gains rates as opposed to ordinary income tax rates. So this is a nice provision. This will be a balancing act that you'll work with your advisory team to see, does establishing Trump accounts make sense, or does the use of 529 plans make sense, and the counterbalance between the twos and the pros and cons. So I just wanted to put a quick slide out there that we're aware of the Trump accounts. In my personal opinion, I think we have more skin in the game related to 529 plans for our planning, but I'd be remiss if I didn't have a slide on this.
Okay, we're going to jump into poll number 3 here. Are you interested in a CPE certificate for today's event? And as you're answering that, just a quick reminder that you can access the polling questions in the poll tab or in the chat, either one. And while you're answering that, we will go ahead and continue to the next slide for time's sake here.
Just want to talk briefly about state conformity. When we talk about state conformity, we mean, do the states follow the federal income tax laws? So most states throughout the country have their own income tax at the state level. We just had significant changes to the federal tax code, the Internal Revenue Code. There are a lot of differences you'll see in the way some states tax income versus the way the federal government taxes the income. One frequent, what we call decoupling from federal law that we'll see is bonus depreciation or Section 179 expense. A lot of you may be sitting in Ohio. The Ohio rules for depreciation on 179 are different than the federal rules. So we do adjustments there. It's not just bonus depreciation in Section 179. There are some states that have different treatment of the business interest expense limitations. Some have different R&D expense limitations. So we do, and then some of those states specifically decouple from provisions. Other states say they follow the Internal Revenue Code as it was enacted on such and such date. So if they follow the Internal Revenue Code as it existed on December 31st, 2024, they're not going to include all of these new provisions that just went into the law. So we will be focused on the states throughout the country over the coming weeks and months and over the next year. I'm sure we'll see a lot of movement. There's a lot of tax deductions that just got reintroduced into the law. So we will be taking a look and have to do planning around which states are following those changes, which states have decoupled. And then one last slide on what the legislation did not do. It did not change the corporate rate. So the corporate rate at 21%, that was made permanent under TCJA. That was not going to sunset at the end of 2025, like the qualified business income deduction was set to do. So the corporate rate is still 21%. And it will be 21% for the foreseeable future unless there's any legislative change. And then similarly, we've not yet seen any changes to the capital gains tax rates. Still have preferential rates for long-term capital gains. Expect those to remain for a while, but as with anything, it's as permanent can be in Washington. There are some other, there's always a lot of chatter about the carried interest, quote unquote loophole. We've not seen any changes to that so far since Section 1061 was introduced. So that was a little surprising not to see anything in this law on carried interest, but happy to not see anything. So That's all I have. I think we'll kick it back to Brendan to cover some of the upcoming events and resources we have.
Yeah, thanks, Zach. So before we are going to have Q&A here for a couple of minutes, folks. So if you want to hang on for that, that'll be coming up here in just a second. But before we jump into that, we just wanted to make you aware of some additional information and events that are upcoming, as you can see on the slide there. You should also receive an email later today sharing the webinar recording in our slide deck. That email will also include a link where you can register for our end of year tax webinars. So we have one for individuals scheduled for Tuesday, November 18th, and one for businesses scheduled for Wednesday, December 10th. So if you are so inclined, feel free to go ahead and register for those events. So with that being said, we can flip to the next slide. Let's go ahead and jump into some questions. There were a lot of questions that came in. We're going to address everything we can here in the next 3 minutes and maybe even hold on for another minute or two. I will make sure to pop up the final poll question here right at 2:30 for anybody that needs to jump off right at the bottom of the hour. We had several questions come in about solar credits and how those are being impacted. And I know there was a slide where the green energy provisions were mentioned, but just wanted to touch on those quickly as several questions came in about solar credits and how businesses can take advantage of those credits and accelerated depreciation. So the new law essentially it eliminates the accelerated depreciation for solar panels. So solar panels and other types of green property, think wind turbines as another example, have been eligible for a 5-year tax depreciation. So that is no longer available starting 1/1 of 25. So we don't get that accelerated depreciation on solar panels. However, one thing that's important to note is that's so the new law just removes that as the default treatment. So solar panels will now be lumped in with kind of the general building category, which can still be cost segregated essentially. So we can still segregate those costs and determine which of those solar panels are dedicated to machinery or equipment. And if they are dedicated to machinery or equipment, meaning that the energy that those solar panels are producing is powering machinery or equipment, we can take those solar panels over the life of the equipment. So it would still have potentially a 5 or 7 year tax life. Again, this new rule just removes that as the default treatment. One other thing to note that we had some questions about, it has to do with the actual credits, the Section 48 investment tax credit that businesses can get who install solar panels, solar arrays. And there were some significant changes between the original House bill and the Senate bill and what was finally passed here. So it's important to clarify these. So the solar credits remain intact but are being phased out. So they remain intact for now, meaning that the actual credit amount is not being changed. However, in order to qualify, you have to begin construction by July 4th of 2026. Or you have to complete construction by December 31st of 2027. It's an either or, okay? So if you begin construction by, again, July 4th of 2026, so roughly a year from now, or you complete construction by December 31st of 2027, you would be eligible for the credit amount in the same amount that we currently have. So just as a quick reminder, those credit amounts are calculated as a percentage of the investment of the cost spend on the solar panels, and that can range anywhere from 5% up to 70 or 80% as a credit percentage. So that does not change. There were a couple of other questions relating to other green energy provisions, but I'm going to pause right here as I see we're at the bottom of the hour, and I want to go ahead and trigger the last polling question if we can, for those that have to jump off right at 2:30. So while you're answering that final polling question, I'll continue. And again, for those of you that are able to hang on for this Q&A, we're going to answer as many of those questions as we can here in the next 5 minutes or so. So a lot of our clients do take advantage of the 179D energy efficient commercial buildings deduction. That again is being phased out. That will only be eligible for construction projects that begin prior to July 1st of 2026. And just as a reminder, that's the deduction that's based on the square footage of the building. Starts at anywhere from 50 cents a square foot, roughly, up to $5 a square foot. And those amounts are adjusted by inflation depending on the tax year. So again, construction has to begin prior to July 1st of 2026. We see that July 1st cutoff coming into play on a lot of these things. Similarly with 45L, which is kind of the sister credit to 179D, but applies on the residential side. For 45L credits, those units have to be sold by July 1st of 2026. Okay, so we talked earlier about what does the word permanent mean, and the fact that anything that's quote unquote permanent can be changed in a heartbeat by Congress. Also, anything that's set to phase out can be changed in a heartbeat by Congress. So, if we're looking forward to 2026, 2027, certainly both the investment tax credit for solar panels and the 179D energy efficient commercial buildings deduction are going to be in play for tax years 2025, 2026, and likely 2027, depending on when construction began and ends. So those are still in play. And then it's going to be, those items will be considered part of the annual tax extenders package that we've become so familiar with over the years. And, do they get extended? Do they not get extended? And what's the timing of that, and how are businesses supposed to plan, not knowing if those items will be extended or not? So, again, to the earlier discussion, the items that are quote unquote permanent are not necessarily permanent, and the items that are, getting phased out are not necessarily getting phased out pending new legislation from Congress. So I'm going to move on to another question here with our last couple of minutes. Question came through on the qualified production property. Can a designer or a design professional benefit from qualified production property? So the answer to that is, and Zach, certainly jump in as needed here. The answer to that is, based on the current law, no. The qualified production property has to be the manufacturing, production, or refining of a product. So that specifically does not include design. So that is unfortunately the design would not qualify based on the current reading of that 168N section, which is the new section that addresses qualified production property. As was mentioned, go ahead, Zach.
Sorry, I was going to hop in. And I don't think, I've not seen anything where, correct me if I'm wrong here, but like an architecture firm could benefit from a 179D deduction at the taxpayer level, or correct me if I'm wrong there, but I've not seen anything in the bill that the designer could benefit from the other taxpayers' use.
For QPP?
Yeah.
Correct. Yes. That's a good distinction to draw there, Zach, because for 179D, architects and designers can take advantage of that deduction if it is a not-for-profit or government project. So in other words, if the taxpayer is not actually a tax-paying entity, so they're a not-for-profit or a government entity, they can assign that deduction to the architect or design firm. That ability to assign that deduction or benefit has not been extended to QPP or qualified production property. So again, it would have to be a for-profit entity, and unfortunately, design, the function of design does not qualify based on the current language. But I think it brings home the point that we have a lot of additional regulations and guidance that are expected, on this specific topic of qualified production property and other areas, which could clarify that and potentially change that definition, right? There's so much just within that one QPP section that needs clarified. It's going to be, certainly several months before we get any clarification on what those different definitions within that section mean. So We are at 2:36, so I just want to wrap up this discussion with a quick question to the group. Generally speaking, what can we expect for the rest of this year? Are there going to be new bills, regulations? Are there additional tax extenders that need to be addressed in 2025? Zach, I know you kind of touched on that there could be an additional reconciliation bill, but is there anything really that we can expect to come through in 2025?
I think as of Monday or Tuesday, Speaker Johnson said that they were going to push through another reconciliation bill. What will be in that bill is anyone's guess at this point in time. I'd assume if there's going to be some action on gambling losses, it would be in there, but
Yep.
it does sound like they are going to try to do something by year end.
Yeah. Another area that still needs to be addressed is the work opportunity tax credit as well. That's hanging out there and needs extension. So we'll see if that comes through. Mark, did you have a comment?
Yeah, I mean, I think based on the timing and the speed of this bill, there's just going to be a lot of clarifications, right? There's going to be a lot of questions that are being asked and demand for clarification. So I think we're going to see a lot of guidance in that area. So taking the interpretation of the law, start to get feedback on that interpretation, and then clarity.
Yeah. Okay. We are at 2:37, so we will go ahead and wrap it up. On behalf of Zach and Brittany and Mark, I just want to thank everybody for attending this webinar. I really hope you found it beneficial, and enjoy the rest of your day. Thanks again.